Many people believe a billion-dollar net worth is the result of inventing a revolutionary piece of technology or working 100-hour weeks until their fingers bleed. The actual process of extreme wealth building follows a different logic. The world's greatest fortunes are built on a meticulously crafted story. When you look at someone like Elon Musk, you see a massive fan base, an astronomical net worth, and a reputation as humanity's singular savior. But pull back the curtain on the actual court records and federal filings, and a different engine emerges. Wealth at this scale utilizes psychological leverage, public relations, and a circular trick of manufacturing credibility. To understand the monopoly of credit, we have to look early in his career. Musk walked away from a lucrative merger for his early venture, Zip2, with CitySearch. The deal collapsed for one primary reason. He refused to give up absolute control over the narrative of the project. When he later entered Tesla, he was not an original founder. The company was already incorporated by Martin Eberhard and Mark Tarpenning. Musk fought internal corporate battles and endured lawsuits specifically to ensure he was legally designated, on paper, as a co-founder. In these early corporate battles, the objective extended beyond simple management authority. It was the legal right to the visionary title. Securing that designation ensured that future successes would be tied to Musk's individual reputation, making his personal brand a primary driver of investor interest in his subsequent projects. Traditional accounting focuses on building a product and seeking investment based on actual revenue. Modern billionaires flip this. They use a strategy of selling the mirage before the oasis, pitching a spectacular promise of the future to court massive investors, and then using that cash to build the thing they promised in the first place. During the 2008 financial crash, Tesla targeted the Department of Energy's $25 billion loan program. Tesla needed the government loan to prove viability to Daimler, but Daimler wouldn't invest without the loan. To break the deadlock, Musk launched a media blitz, publicly announcing the loan was a done deal before submitting the paperwork. This engineered projection of confidence gave Daimler the trust they needed to officially partner with him. This projection of confidence serves as the catalyst for corporate trust. By manufacturing a sense of inevitability, a founder can secure the institutional funding necessary to turn a promise into a reality. While the public focuses on standard product sales, a powerful engine of wealth lies in navigating government rulebooks with more precision than the regulators themselves. For years, financial headlines praised Tesla for achieving profitable quarters. A look at the actual line items of their SEC filings reveals the real source driving those margins: regulatory carbon credits. Imagine a straight A student selling extra credit points to a failing student for cash. The teacher passes both, though no net learning occurred. Similarly, Tesla generates massive environmental credits, selling them for pure profit to legacy automakers failing emission standards. This single loophole injected billions into Tesla's balance sheet, artificially inflating financial performance and drawing in waves of retail investors reacting to top-line profits. Tesla's windfall from carbon credits highlights a central rule of modern wealth. Profit often comes less from the efficiency of the assembly line and more from the strategic harvesting of government-mandated financial incentives, which brings us to a specific banking loophole. The richest people in the world afford private jets and lavish lifestyles, while claiming zero income and maintaining low cash balances. Musk's compensation is almost entirely tied to stock options. If he sells those shares for cash, he triggers massive capital gains taxes and signals to the market that an insider is cashing out, which can drop the stock price. Instead of selling, he uses his massive blocks of Tesla stock as collateral to secure personal loans directly from major Wall Street banks. To the IRS, a loan is not taxable income. You can live on borrowed money indefinitely, using your appreciating assets as a shield from the tax code. While most standard corporations forbid their executives from doing this, Tesla's board explicitly allows it. The average person uses debt to purchase depreciating consumer goods. The ultra-wealthy use their appreciating assets to secure debt that keeps them liquid and untaxed. The final rule of this architecture is that a company's market cap rarely reflects its current physical output. It is a reflection of its narrative. Musk has admitted that Tesla's valuation doesn't stem from the number of cars delivered. It relies almost entirely on the unfulfilled promise of solving full self-driving technology. If that promise fails to materialize, or if the public stops believing in the vision, the stock price loses billions in value overnight. The financial reality of the enterprise is tethered to the myth of the founder. Real wealth in the modern economy is built on 5 leverage points: asset control, manufactured credibility, regulatory loopholes, asset-backed debt, and anchoring a brand to a future promise. Analyzing these specific mechanics, from narrative control to tax-shielded debt, makes the logic of modern fortune building visible. Understanding this framework provides a realistic look at the infrastructure required to build and sustain a modern financial empire.